Tonight we bring you a story of power, money, and the fragile balance that underpins our global order, a balance that, until now, many believed was unbreakable. This week, a tremor shook the world's economy, not from nature, but from the heart of Beijing, sending ripples through every major financial center. China, once America's largest foreign creditor and a pillar of the U.S. bond market, has begun a massive, unprecedented sale of its U.S. Treasury holdings, a move that few thought would ever actually happen. The numbers are staggering, the timing deliberate. This is not just a financial transaction, it's a declaration, a signal to the world that the rules of engagement are changing. The economic symbiosis between Washington and Beijing is fracturing, sending shockwaves from Tokyo to London to New York, and threatening the very fabric of global finance. Global markets thrive on stability. Now they're in chaos. Trading floors in panic, indices plunging, investors scrambling to make sense of the new reality. This isn't just a headline for economists or traders. The tremors threaten pensions, mortgages, and jobs. Real lives and futures are suddenly at risk. We are witnessing the weaponization of finance on a scale never seen before, where money itself becomes a tool of geopolitical strategy. For years, analysts whispered about this nuclear option, China using its US debt as leverage. Now theory has become reality, and the consequences are unfolding in real time. The move comes just days after new US tariffs on Chinese tech goods, a direct, forceful retaliation that has escalated tensions to new heights. It's a high-stakes gamble, risking not just the US and China, but the entire global economy. Every nation, every market, is now watching and waiting. The question is no longer if this could happen, but what happens next? The world is holding its breath. This is about more than numbers. It's about shifting global power, the future of the US dollar, and the financial ties that bind us all together in an increasingly interconnected world. In the next moments, we'll unpack how we got here, the immediate fallout, and what experts say comes next for markets, governments, and ordinary people. The world has entered a new, uncertain chapter, one where the old rules may no longer apply. Understanding what's at stake has never been more critical. The decisions made in the coming days will shape the future for years to come. This is a moment of truth for the global financial system, a test of resilience, trust, and the ties that hold the world economy together. To truly grasp today's unfolding crisis, we must look back at the roots of the global financial system and the forces that shaped it. China's vast U.S. Treasury holdings are not an accident, but a direct product of decades of globalization and economic interdependence. After joining the WTO in 2001, China rapidly transformed into the world's factory, amassing a huge trade surplus with the U.S. as American demand for cheap goods soared. The question then became, what should China do with all those incoming U.S. dollars? The answer was clear. Buy U.S. Treasury bonds, the world's safest and most liquid asset, trusted by investors everywhere. This created a unique, symbiotic relationship between the two economic giants. China's massive purchases kept U.S. interest rates low, fueling a boom in American borrowing and consumption of Chinese-made goods. Both nations benefited: cheap credit and rising living standards for the U.S., rapid industrial growth, and job creation for China. At its peak, China held over $1.3 trillion in U.S. treasuries, making it America's largest foreign creditor and a key player in global finance. But this codependency was always uneasy, shadowed by mutual suspicion and strategic rivalry. U.S. politicians frequently accused China of manipulating its currency to gain unfair trade advantages. Meanwhile, China worried about overexposure to the dollar and the risks of relying too heavily on a rival's financial system. The 2008 financial crisis was a wake-up call for Beijing, exposing the dangers of tying national wealth to the stability of another nation's economy. In response, China began a slow, deliberate process of de-dollarization, seeking to reduce its vulnerability. Quietly, it diversified into European bonds, gold, and global infrastructure projects, building new sources of strength. For years, China trimmed its holdings carefully, never dumping them outright, until now. In November 2025, everything changed. The strategy shifted dramatically. Quiet diversification gave way to aggressive selling, sending shockwaves through global markets. The slow leak has become a torrent, signaling Beijing's willingness to inflict financial pain, even at the risk of global instability and self-harm. The financial weapon is now out of its silo, unleashed onto the world stage. The world is watching closely as China rewrites the rules of economic engagement, challenging the old order. The era of quiet codependency is over, replaced by open confrontation and uncertainty. A new, more confrontational phase has begun, one that could reshape the global economy for years to come. Let's break down what happened. On November 3, 2025, the U.S. Treasury confirmed China had offloaded $150 billion in U.S. securities in a single week, the largest sell-off by a foreign central bank ever. This was no subtle adjustment, it was a calculated market intervention. The timing followed Washington's ban on advanced semiconductor exports to China, a clear message of retaliation. China spread its sales across maturities and intermediaries, maximizing disruption and uncertainty. As the largest buyer became the largest seller, U.S. bond prices plunged and yields spiked. The benchmark 10-year Treasury yield surged from 4.2% to over 5.5% in days, the fastest jump since the early 1980s. For the U.S., borrowing costs soared. For everyone else, higher rates are coming fast. Beijing's message was delivered in the cold, hard language of markets. The consequences are immediate and severe. Markets are thrown into chaos as investors scramble to make sense of the sudden shift, and panic spreads quickly through the financial world. The U.S. government now faces sharply higher borrowing costs, with China no longer a buyer, but a major seller. This reversal sends shockwaves through Washington and Wall Street alike. To attract new investors, the Treasury must offer higher yields, diverting taxpayer money from services to debt payments. The government's budget is squeezed and tough choices loom. This spike in yields ripples through the economy. Mortgage rates jump, car and student loans get pricier, and household budgets are squeezed. Everyday Americans feel the pinch almost overnight. The dream of homeownership slips further out of reach for millions, as rising rates push monthly payments beyond what many can afford. Globally, the impact is just as profound. Financial markets from London to Tokyo react with alarm, and uncertainty spreads across continents. U.S. Treasuries are the backbone of the international financial system. As their value falls, central banks worldwide take losses, weakening currencies and stoking instability. The ripple effects are felt in every major economy. Commodities priced in dollars become more volatile, threatening global trade. Oil, metals, and food prices swing wildly, making planning difficult for businesses everywhere. For China, the move is risky. The world watches to see if Beijing's gamble will pay off or backfire. Dumping treasuries devalues its remaining holdings and could hurt its own export-driven economy, as a weaker dollar makes Chinese goods more expensive abroad. Beijing is betting the US will suffer more, but the pain is global. No nation is immune from the fallout. The calculation is dangerous and costly for all. The world's financial system is suddenly on shaky ground. The world's financial architecture is under stress. Banks, investors, and governments scramble to adapt to the new reality. The fallout is just beginning. Uncertainty and fear grip the markets, and no one knows how deep the crisis will go. The stakes have never been higher. Leaders rush to respond, but solutions are elusive and time is running out. Every corner of the globe is feeling the shock. From small towns to major cities, the effects are impossible to ignore. The era of easy money is over. A new, more uncertain chapter in the global economy has begun. China's treasury dump is a bold move on the geopolitical chessboard. It signals the end of unchallenged U.S. financial supremacy and the start of direct economic confrontation. Beijing is inviting other nations to join its alternative financial systems, challenging the dollar's dominance. U.S. allies, Japan, South Korea, the UK, are caught in the crossfire, pressured to buy treasuries and stabilize markets. The crisis tests the strength of Western alliances and could accelerate the fragmentation of the global economy. The stakes are now deeply geopolitical. Behind the headlines, real people are hurting. Higher mortgage rates mean families are priced out of homes. Small businesses face rising costs and tough choices. Retirees see their savings erode as bond values plunge and markets swing. In developing nations, dollar-denominated debt becomes crushing as U.S. rates rise, triggering austerity and hardship. Even in China, economic pain could threaten social stability. The financial battle between superpowers is inflicting the greatest suffering on the world's most vulnerable. To make sense of this crisis, we turn to the experts. Dr. Evelyn Reed, former Fed economist, says, "We've crossed the Rubicon. Beijing is willing to absorb pain for strategic gain. The game has changed. The Federal Reserve faces a dilemma: intervene to stabilize markets and risk inflation. or let rates soar and risk recession. There are no good options. David Chen, U.S.-China relations specialist, warns, this is no longer just a trade war, it's a full-spectrum rivalry. Beijing is testing U.S. resolve. The risk of escalation is real. Retaliatory financial measures could destabilize the global order. The dollar's dominance is now in question. Countries will look for alternatives, accelerating the search for a new reserve currency. November 2025 may mark the beginning of the dollar's slow decline. Experts agree, we are in uncharted territory. The risk of miscalculation is dangerously high. The world is watching for the next move. The stakes are existential for the global economy. The old rules no longer apply. The future is uncertain. As the dust settles, the world asks, what's next? Central banks are scrambling to prevent panic. G7 leaders are meeting in emergency session. Washington faces a choice: de-escalate and negotiate, or retaliate and risk a spiral. For China, the question is whether this was a warning shot or the start of a sustained campaign. The world's financial stability now hangs on decisions made in Washington and Beijing. The challenge: find an off-ramp before the damage becomes irreversible. The hope: that crisis forces a return to diplomacy. We stand at a crossroads. The weaponization of finance is no longer theory, it's reality, with consequences rippling across the globe. The era of economic peace is shattered. The tools of commerce have become weapons of conflict. The immediate task: contain the damage and prevent a global recession. The long-term challenge: rethink how major powers compete in an interconnected world. Will this be the dawn of a new Cold War, or the shock that forces negotiation and a new global order? The choice is not yet made. It depends on leaders, policymakers, and citizens who understand what's at stake. We are all participants in this story. Knowledge is our best defense. The future of global prosperity depends on what we do next.